Good morning. My name is Mark Henry. I'm a partner at Citrin Cooperman, and I'm joined by my fellow practice leader of Citrin Cooperman's Manufacturing and Distribution Group, John Giordano. John's going to be handling the Q&A section of this program towards the end of the program. So if you have any questions, feel free to hit the Q&A function, or he'll be handling those at the end. With all the uncertainty in the past few months, we are extremely happy to have Dr. Anirban Basu with us again to share his thoughts on our 6th annual Pulse Survey report and also his vision for 2025, specifically for manufacturing and distribution companies. As you all know, there is a lot going on. In our survey, we polled over 500 owners and leaders of privately held businesses to get their insights into their biggest successes and also the challenges that they faced over the last 12 months, along with the opportunities that they see ahead of them in the next 12. This year's survey even drills further into sub-industries such as food and beverage, consumer products and retail, industrial products, distribution and logistics, and manufacturing. If you haven't had a chance to download our survey yet, it's available on our website, citrincooperman.com. Now for our guest speaker. Dr. Anirban Basu is Chairman and CEO of Sage Policy Group, a Baltimore-based economic and policy consultancy firm, which he founded in 2004. He serves in the chief economist function for many organizations. He's the distinguished economist in residence at Goucher College, where he teaches history of economic thought. He holds 4 graduate degrees, including a JD and a PhD. Dr. Basu, thank you for joining us again this year.
Thank you for having me, Citrin Cooperman, and let's talk about the economy through the lens of this survey. This survey is chock full of surprises. It's fairly shocking, some of the outcomes in the survey, some of the surprises, at least as an economist. And I'll talk to you about why I'm surprised, and we'll leave some time at the end of this for Q&A. So let's get into this survey of manufacturers and distributors. We'll talk about the major findings, which include, for instance, slowing growth. That's not so surprising. Rising technology, and of course, looming and actually in existence tariffs. So we'll talk about all of those things. I will not ignore tariffs in this discussion, but we're going to talk about so much more than tariffs, and that might be one of the most surprising aspects of this. So here's a survey, key findings, major findings. One is that manufacturers and distributors are going through all kinds of gyrations right now. I mean, changes in the air. So the top changes, if you look at operational shifts, top changes companies experienced in the past 12 months include rising employee costs. Now, let's pause on that. And because this is an economy that everyone's been talking about is approaching recession. At first quarter, GDP growth was negative on an annualized basis. Second quarter will be positive, but first quarter was negative. And so the notion is this economy is slowing down, hiring has softened, and yet, you know, employee costs are rising. New warehouse/facility openings, 35%. And so again, many distributors, for instance, are on the front foot, continue to open up new facilities, and then new ERP implementation, enterprise resource planning, and so on. So you know, and that's interesting, whether that's, you know, products from SAP or Oracle or whomever it happens to be. And so you look at that, these operational shifts, you say, hey, these people are still on the front foot. So all this talk about recession, the Institute for Supply Management's Manufacturing Index, which has been in recession for much of the last 3 years. And yet, I still see forward movement here. Revenue growth is slowing, however. So the economy is moving forward. You know, many adjustments taking place in the context of tariffs and other supply chain issues, but revenue growth is slowing. And so maybe that's why there's so much shifting out there, is because people are trying to maintain their corporate earnings, and to simply do that, you have to be very, very active. And we'll talk about that throughout this presentation. So while 77% saw revenue growth in 2024, so that's a big number, 77%, that's down from 93% in 2023. Only 17% of manufacturing/distribution leaders reported significant growth compared to 49% last year. So revenue growth has really softened. And so let's talk about that. What have been some of the experiences over the past year? Which of the following has your company experienced over the past 12 months? Increased employee costs, we talked about 40%. Opening a new warehouse or manufacturing facility, 35%. Implementation of a new ERP, 31%. I mean, think about that. I mean, implementing these things is not easy. It takes up a lot of staff time. It's fraught with risk. And yet about a third of our respondents said, yeah, we've done that just in the last 12 months. Some of the other interesting things here, have you experienced a cyber incident or breach? 26% said yes. That's a quarter. Impacted by tariffs, 23%. Well, that's shocking. I mean, tariffs are the headline all over the place. So you'd think that number should be 100%, you would think. I mean, we're talking about distributors and manufacturers. Who's going to be more affected by tariffs than those types of economic actors? And yes, 23%. Now, maybe it's because these tariffs have only been recently implemented, whether on steel and aluminum, or the Canadians or the Mexicans, or of course that 10% across the board tariff that relates to the April 2nd Liberation Day announcement, with those reciprocal tariffs paused until July 9th. Labor shortage, 21%. None of the above, 3%. So 3% of you experienced nothing over the past 12 months. It's amazing you're still in business, but nonetheless. So that's what we have. Now, let's talk about those revenues. So this slide gets to EBITDA and revenues comparing 2023 and 2024 and 2025, and actually giving you some history back to 2021 and 2022. So if you look at the left-hand part of this slide, it's EBITDA. Earnings before interest, taxes, depreciation, et cetera, dividends, et cetera. So if you look at the 2025 survey, that's the last bar there on the right. So you look at that, the green segment represents significant growth in EBITDA. Okay, this year's survey, 19%. Last year's survey, 49%. That's a big delta, don't you think? In fact, if you look at that, the proportion reporting significant growth is the worst since the 2021 survey. And of course, 2021 was the year of a lot of the supply chain issues and the lingering COVID effects, so on and so forth. So again, this speaks to a slowing earnings picture. And of course, part of that is a slowing economy, which brings us to the right-hand side of the slide, revenues. So again, the green segment is significant growth. The yellow segment is some or modest growth. Now, again, you add that number up, 17% plus 60% there in that right-hand column, the 2025 survey, that's 77% are saying revenues grew. So I don't want to make a mountain of a molehill, but compare that to 2024 survey when 49% said we had significant growth in revenues compared to 17%. That's statistically significant. And I'm going to show you some results where the changes in percentages between years has been quite modest. And there you cannot necessarily claim statistical significance. In other words, you cannot make the claim that the 2024 outcomes were statistically different from the 2025 outcomes. It's just a modest percentage change. That's statistically significant, 49% to 17%. Now, a lot of the people who, went from significant growth, went to some modest or modest growth, 45% to 60%. But again, it speaks to an economy that is softening. So to the extent that there has been expanded profitability, what are some of the top drivers of that profitability? What are the main drivers for the growth in EBITDA? Increase in product demand, 37%. Again, I don't think it speaks to an economy in recession. Lots of talk about recession right now. I'll talk about it later on during the presentation. But again, a lot of these numbers suggest that still on the front foot, the economy is slowing, but in response to that slowdown, many companies are making significant investments, including in human capital, but equipment, et cetera. We'll talk about that. Maybe to become more efficient, and so to retain their earnings even in a slowing macroeconomic environment. Stabilization of product demand, 32%. Introduce a new product line, 30%. Improvement in demand for their product, 30%. Revenues are up 28%. Margins are up 25%, right at the very bottom there. So, we also had some indicating that they had the ability to pass on inflation in inventory and supply costs, 27%, overhead costs decreasing 26%, so on. So these are the main drivers, but here's the takeaway. I mean, lots of data here, but the point is it's still an economy, or at least a manufacturing distribution segment of the economy, that is still in the process of investing itself, trying to expand capacity, trying to improve productivity. So let's talk about some other major findings here. And this, again, relates precisely to what I just mentioned, the goal of improving productivity. So technology investment rises. Companies are prioritizing ERP systems, enterprise resource planning, AI and cybersecurity to enhance operations. By the way, and I don't know if this is insider trading, when I saw these results, one of the first things I did was I went out and bought Oracle stock. I don't know if I can say that. I'm supposed to say that. I just already said it, and this is being taped, so it's too late now. But because if companies like yours are investing that much in new ERP technologies, new systems, well, of course, Oracle is a major player in that, along with SAP and others. Don't get me wrong, SAP, the German company. North America leads sourcing. So 62% of companies primarily source from North America. So that's something to think about as we go through these survey results, is that roughly 3 in 5, a bit more than that, primarily sourced from North America. And so the tariff implications for them are different from those, the nearly 40% that rely more heavily on global suppliers. And of course, tariff concerns are growing. 71% of respondents expect tariffs to impact businesses, with 50% anticipating negative effects. So, and even if one is purchasing their inputs, let's say, into their manufacturing processes from domestic producers, let's say it's a Nucor Steel or Cleveland Cliffs, even then, of course, the tariffs have impact. Because if I'm a domestic producer, of course, I can raise my prices if my foreign competitors are having to pay taxes effectively. I mean, obviously the importer is paying the taxes, but if effectively they're suffering greater burden from taxation because of these tariffs, I can raise my prices and remain competitive. And actually, you're seeing that in some of the steel company prices and other commodities that are domestically produced and would tend to benefit in terms of pricing power from these tariffs. Some other major findings from the Citrin Cooperman Manufacturing Distribution Pulse Survey. This is one of the great shocks of the world here, as far as I'm concerned. Because all I'm thinking about all the time is inflation. I'm thinking about the Orioles too, who are fighting for 4th place with the Boston Red Sox. We'll get there. But the point is, inflation concerns are fading. Well, that's unbelievable to me. Because all we've been talking about is the tariffs, and the Federal Reserve stuck at a high federal funds rate because they're worried about future inflation. We got consumer sentiment sagging in the population because people are worried about existing inflation, but also prospective inflation. You saw all of that purchase of imports during the first quarter of 2025 as people tried to beat tariff pricing. Why are you buying in the first quarter when you normally would have bought in the second or third quarter? Because you think the price is going to go up in the second, third quarter. And why is that? Because of tariffs. So here's what I'm thinking as a macroeconomist. People are really worried about inflation. Only 18% of companies cite inflation as their top challenge, down sharply from 41% last year. Well, last year, President Biden was president of the United States, and we did not have all this talk about tariffs, whether the tariffs on steel and aluminum with 25% as of March 12th, but of course recently increased to 50%, or the tariffs on Canada and Mexico. Of course, April 2nd was Liberation Day, when those reciprocal tariffs were announced. Liberation Day sounds like a national holiday. It's not a national holiday, though, of course, the millennials asked for the day off. But the point is, you would have thought that under such circumstances, we'd have a lot more inflation concern. Only 18% of companies cite inflation as their top challenge. Capital and tech adoption lead concerns. Oh, this is interesting, too. High capital costs, 25%. That's those interest rates. For instance, the Federal Reserve is stuck. You might say, oh, Anibal, they cut rates late last year, September 18th, a 50 basis point rate cut, half a percentage point. On November 7th, 2 days after election, another quarter point rate cut. And then December 18th, a quarter point rate cut. That's true. But the benchmark interest rate, so if you look at the upper limit of the federal funds rate, the primary mechanism by which the Federal Reserve influences economic growth as byproduct of inflation, before the rate hikes that began on in March of 2022, that was sitting at 0.25%. It goes up to 5.5% by July 26th of 2023. That's when the rate hiking stopped. But that's a 525 basis point increase in interest rates. And then last year came down by 1 percentage point or 100 basis points. Interest rates are still high. So high capital costs, 25%, and workforce adaptation to new technologies now rank as the most pressing issues. So here it is. From the following list, what are your companies, or what is your company's biggest challenge today? Number 1 is high cost of capital. Well, let's talk about tariffs. Number 1 issue among the people on this call, interest rates, or high cost of capital generally. Ability for workforce to utilize changing technologies, 23%. Because over new ERP systems, of course, artificial intelligence and all the rest of it. Rising interest rates, 22%. And we actually have in recent weeks seen an increase in the interest rates at which we transact. Things like mortgage rates, for instance. But the yield on the 10-year treasuries I'm speaking to is 4.5%. That's been up over the last couple of months, generally speaking. Obviously, it goes up and down, but higher than it was a few weeks ago. You can see now toward the bottom, what you see, requirements, right? We all have requirements. But above that is rising inflation. That's down below as the biggest challenge. So again, you can understand why I'm so surprised as a macroeconomist. So let's talk more about that advanced technology, because that's where the push is right now. So what are some of the highlights? Well, of course, no surprise here, as it turns out, AI's growing influence. 69% of companies say AI had the greatest impact on their business over the past 3 years. AI. And we're just getting started, as you know. Yet only 7% have mature adoption, 39% are in early stages. There's so much work to do on AI. And almost every interview that I see on Bloomberg or CNBC or elsewhere, Fox Business, people come on and say AI, AI, AI. And whether they're talking about stock prices of Nvidia or whatever it happens to be, just these use cases that are growing in corporate America among manufacturers, distributors, etc. ERP upgrades come. We've talked about this, but 2/3 of upgrade ERP systems to better support growth and value creation recently. Cybersecurity efforts expanding. Well, of course, when you have about a quarter having some kind of data breach, 55% offer cybersecurity awareness training, 47% actively monitor cyber activity. Wait a second, that means 53% are not actively monitoring cyber activity, if I'm reading that correctly. Shouldn't we be actively monitoring that? Whether you're a manufacturer or distributor, I would think so. But again, people are just trying to keep up with just the craziness of economic life. And so some things can't be done all the time. And then data-driven competitiveness. Over half of companies link future success to using ERP data for supply chain forecasting or customer data for behavior prediction. Hence, I bought Oracle stock. So AI is having the most impact on business. So what technology/initiatives have had the most impact on your business over the past 3 years? So again, we talked about artificial intelligence, cyber and data security, 53%, business intelligence, 52%. That again relates to those ERP systems, for instance. Internal systems integration, 41%. External systems integration, customers and vendors, 32%. New ERP, 28%. And then 0% said we have not had any significant business technology initiatives, 0%. So everyone's on the front foot with respect to their data, their technology, artificial intelligence. This is a moment of change. There's no sitting down if you're a CEO or COO or CIO or whomever you happen to be. This is a time of just active change. Your competitors are really active right now trying to improve their business efficiency and to protect themselves from external risk. And I presume that all of us are aware of that, and so you have to be active too, I suppose. Everyone has to be active. AI adoption curve/common uses. Again, this comes from the Citrin Cooperman Manufacturing Distribution Pulse Survey. Again, thank you to Citrin Cooperman. These data do not exist but for them. And their significant focus on manufacturing and distribution as economic activity. So which of the following is true about the use of AI in your business? Okay, this is interesting, I think. We have emerging organizational adoption of more structured use of AI-powered assistants, such as Microsoft Copilot, and are in a learning phase of what's possible, 39%. Learning phase. We actively use GitHub/ChatGPT or equivalent AI agents to help with preparing business documents, doing general research, and/or engaging in marketing activities and to enhance client communications, 32%. We have organizational adoption of AI-powered assistants like Copilot and are actively using it to aggregate business communications data across email, Word, Excel, and PowerPoint files, 21%. Here's perhaps the most interesting result on this particular slide. We have a mature AI adoption that includes ERP business data along with all of the above services, 7%, which means 93% do not have mature AI adoption. So if you do not have mature AI adoption, know that you're in the vast majority. We are not using AI in our business, 1%. We are not using AI in our business. That's interesting to me, 1%. Now, it's not many people, but there are some people out there who are still not. So in any case, now, I would point out that 7% that says that we have mature AI adoption, that doesn't mean they don't have to continue to change that model, right? Because AI is becoming more powerful all the time. And so it seems to me that they might feel that they have mature AI adoption, but in 6 months, if they don't do anything along that dimension, it may not be so mature anymore. So let's talk about more issues here, including supply chain logistics and looming tariffs. So again, tariffs have been the talk of the town, not just Washington, D.C., but the entire country, of course, and the entire world. So 50% of respondents say the top strategy to manage product cost is to manufacture in-house, which of course is the goal of the Trump administration. But to the extent that people are manufacturing abroad, offshore, that kind of thing, if you bring that manufacturing in-house, and everyone that's in the survey is American manufacturer, right, or distributor, the manufacturer in-house, or at least they have operations in America. Top reshoring challenges are lack of tax incentives, 52%, and cost of U.S. labor, 52%. Okay. The top reshoring challenges are lack of tax incentives, 52%, and cost of U.S. labor, 52%. Okay, a couple of things about that. One, the tax incentives could come back. Those of you who have been following that one big beautiful bill know that there is the restoration of 100% bonus depreciation integrated into that bill. That's my understanding. And also some new tax advantages for those engaging in private research and development activities. Now, with respect to cost of U.S. labor, you say, well, there's not much we can do about that, but there is, isn't there? I mean, as far as I can see, Generation Z, and those are the youngest members of our workforce, they were born between 1997 and 2012, according to the conventional definition. So the most senior of that group will turn 28 this year. So many of them are very early career or still in school, but that generation grew up during the student debt crisis. As you know, many Americans are now having to start repaying their student debt down under the Trump administration. And so that concern is out there. And therefore, my sense is that among Generation Z, unlike the millennials and Generation X and the boomers, who tended to grow up during a time when the emphasis was on service sector activity, four-year college degree to become an accountant, lawyer, economist, whatever it happened to be, that more of these young people are open to not going to a four-year college, maybe going to a two-year college, maybe entering an apprenticeship program and becoming a welder or HVAC professional or mechanic or millwright or machinist or whatever it happens to be, electrician, pipe fitter. And so maybe that will help moderate the cost of U.S. manufacturing labor, at least going forward. It's a thought. There's no guarantee there, obviously. Now, if you look below on this slide, the bottom half, where do you source a substantial amount of your products from? So the first numeric column there is 2024. The second numeric column is 2025. North America, and again, I'm shocked. And maybe that's just I'm not that smart and I don't know that much about economics, and that's probably what you're thinking. But here's the thing, again, the goal is what? Reshoring, at least for the Trump administration, right? Bring manufacturing back here. That steel, aluminum should be manufactured in America. That's the notion. And so should computer chips and pharmaceuticals. But if you look at where do you source a substantial amount of your products from, North America, in 2024, the answer was 72%. 2025, it was 62%. I would expect the exact opposite in terms of direction. Now, where did that market share go? Asia Pacific, 8% to 11%. South America, 5% to 8%. Where did it fall? Well, Europe, 10% to 8%. And then Central America and the Caribbean, 4% to 7%, which is interesting, right? Because in this survey, there's roughly as much product sourcing, at least in sort of fraction of companies that are answering in a particular way, between South America and Central America. Well, South America is much bigger, right? That's Brazil, Argentina, so on and so forth, Chile, Peru. Central America is different. It's Ecuador, Guatemala, so on and so forth. And yet, you still see, that number at 7% and rising. So what are some of the hurdles to reshoring? Because I'll say many of the economists with whom I speak, love the idea of reshoring, by the way. They feel like, well, America needs to diversify its economy. That one of the goals of the Trump administration is to bring more production back to the United States of America. But the thing is that manufacturers know these are only going to be in power for another 3.5 years. And with the tariffs shifting all the time, right? One day it's 145% against China, the next day it's 30%. Or one day the tariff on steel is 25%, the next day it's 50%. How do I, it's changing all the time. How can I make any kind of long-term decisions to reshore? 26% are considering reshoring under these circumstances. Now, again, the question was asked in the context of tariffs. So there are some other reasons that people might reshore beyond tariffs, but tariffs are a driving factor here, despite that 3.5-year term limit. To mitigate tariff exposure, companies are using demand planning, 46%. We'll talk more about that. Freight consolidation, 40%, and alternative sourcing, 40%. Again, the goal, drive down cost. 71% say tariff increase will directly or indirectly impact their businesses. And here's the thing, half expect a negative effect. And that's the kind of result I might have anticipated. from such a survey. So if tariffs were to increase, how would this impact your business? So next couple of slides are about tariffs. So let me start with that green segment in this pie chart. So how would this impact your business if tariffs were to increase? Direct impact, most of our products will be impacted by tariffs 28%. That's a big proportion. So there might be other issues out there, including how do I implement AI or integrate AI into my operation, but 28% say our products will be impacted by tariffs. If you look at US imports, by the way, 50% of US imports are intermediate goods. They're goods that go into a manufacturing process, as opposed to the other 50%, which are largely consumer goods. Right? So direct impact, 28%. Indirect impact, our products are sourced in the United States, but pricing will fluctuate based on international tariffs, 43%. And again, that's that Nucor Steel or Cleveland Cliffs or others who can raise their prices because their foreign competitors are having to bear more cost. Then the gray segment there, no impact. Most of our products aren't impacted by tariffs, 13%, but that's a relatively small proportion, around 1 in 8 respondents. And then we are exploring tax strategies to mitigate our tariff exposure, 15%. Yeah, explore those tax strategies. That's right. That's Citrin Cooperman right here. So, and they'll be on in about 15 minutes or so. Tariff impacts, second part, reshoring. With the possibility of increased tariffs, is your company considering any of the following? I'll start with the blue colored segment there and move clockwise. Reshoring manufacturing to the US, 26%. We talked about that figure. Nearshoring to a country close to the US, Mexico or Canada, 20%. Now, as you know, there are 25% tariffs on Canada and Mexico, but not for USMCA compliant goods, United States, Mexico, Canada Trade Agreement compliant goods. And so I guess part of the trick there is to make sure that if you're going to produce in Mexico or Canada, that those products in fact satisfy the test set forth by USMCA for that favorable tariff treatment. Green segment, our company already manufactures our products in the US, 46%. And then the yellow segment, we are not reshoring, even with the potential of increased tariffs, 8%. And I would have expected that number to be bigger. Because as I understand it, when you set up a major facility, whether in China, Vietnam, Malaysia, Bangladesh, India, Bolivia, Argentina, wherever it happens to be, Mexico, et cetera, it's hard to move or to divorce oneself from that capital and then to install new capital in the United States, for instance. But only 8% said we are not reshoring with the potential of increased tariffs, even with the potential of increased tariffs. So what are some tariff exposure mitigation strategies? Which of the following supply chain strategies have you implemented to mitigate tariff exposure? Demand planning. As I understand it, that would be something like inventory management. Right? I do not want, as an importer, for instance, let's say I'm a distributor and I'm an importer, I'm not paying that tariff. I do not want to have in my warehouses a bunch of products that have been sourced from abroad and for which I have had to pay, this significant fee, this additional tariff, sitting in my warehouse. That's expensive. So I want to, move that product out as quickly as possible. I really want to understand demand. Freight consolidation, 40%. Alternative sourcing, 40%. That makes sense, right? I mean, some products are more exposed to tariffs than others, so alternative sourcing makes all the sense in the world. Harmonized tariff schedule reviews, 36%, foreign trade zone, 32%, tariff engineering, 32%, duty drawback programs, 29%. Now we're getting some complexity, aren't we? Some real analytical complexity. How do we handle this? What is tariff engineering? How do we make that work? Right? Duty drawback programs, how complex are they? How do we make those relevant to our enterprise? First sale, 23%. I haven't implemented any, 3%. I haven't implemented any. That doesn't surprise me. I would think a lot of people have responded to those tariffs. So what's the outlook here? Let's talk about that. Growth headwinds and risk mount as new tariff storms gather. And look, I have a bias here. I'm an economist. And as I was in school, I have 4 graduate degrees, as has been said during the introduction. I spent a lot of time in school, and there was no professor who said to me, we love trade barriers or elevated trade barriers. None of them. Very few of my professors talked about fair trade. It was always free trade, free trade, free trade. I mean, I was educated in the post-World War II environment. And so what was the story here? We had tariffs in the 1930s. It helped create the environment that led to World War II. Millions of people died. But then after World War II, we learned our lesson. We created institutions like the General Agreement on Tariffs and Trade, which became the World Trade Organization. We created the United Nations and the International Monetary Fund and the World Bank and all these institutions. so that we could bring the world together. So instead of fighting wars, we trade with one another. Even if we were mortal enemies, America, China, whomever, we would trade. And therefore are less likely to go to war. And sure enough, we have not had World War III, a point often made by professors. So I don't love barriers to trade. That's a bias of mine. I understand the administration's goal, and I'm told on Fox News, which again, I watch a lot, that the president's playing 4D chess. So we'll see what the end game looks like here. But that's a bias of mine, and I'm admitting that. So here's one thing. Despite all this tariff mania, companies still expect to grow. 38% of companies predict a significant increase in workforce investments or upgrades. People are on the move. Now, this might lead to shrunken profitability in the short term because of all these investments and workforce and other other aspects of the enterprise. But the goal, of course, is to position one or reposition oneself to really grow profitability in the out years, I suppose. 37% anticipate a potential expansion into a new facility or plant. Again, on the front foot. In terms of investment, again, that's expenditure in the short term. Interest rates are high, so it's even that much more expensive to construct or develop a new facility or plant. But nonetheless, 34% are planning for capital investments exceeding $1 million. 28% are planning or entering new states, and 24% are planning or entering new countries. So expansion expectations, just to summarize this in a graph, because some people are very visual. Which of the following, if any, do you anticipate occurring for your business over the next 3 years? Significant increase in workforce, 38%. That's the leading answer. Does that sound like an industry on the back foot that's sort of in panic? No. Sounds like an industry that, people are on the front foot. That's part of America. It's one of the reasons I think that the American economy exceeds expectations as a general proposition and exceeds the performance of other societies as a general proposition, is because corporate leaders in America are always looking to grow, whatever the context. They don't just whine and moan about, hey, interest rates are too high, which they're lower. These tariffs are starting to affect my input costs. Okay, they are. I would like maybe things to be a bit different, but I want to plow right through it. Significant increase in workforce, 38%. A potential expansion of business into new facility or plant, 37%. Capital investment exceeding $1 million, 34%. Entering new states, 28%. Now, significant decrease in workforce, 25%. Well, that's interesting. So there's, we have 2 feet, there's 2 shoes, and that's the other shoe dropping perhaps. That some of these companies are not as well positioned for the changes that are occurring, including in terms of input costs. Entering new country, 24%. Sale of business, 24%. Oh, that's interesting, isn't it? And I think that's one of the things that comes out of the survey, and there's some other results that I'll talk about in a moment, that M&A activity will be ferocious going forward. Lots of consolidation. And I would suspect that as interest rates fall, which makes financing such deals more economical, that you'll actually see an acceleration in M&A activity, and a lot of people are planning to sell their business or to acquire another one, because look at the next result. An acquisition of another business operation, 24%. There's going to be lots of, so people are look at that, 24% each way. So look, if you're thinking of selling your business, know that an equivalent number of people apparently want to acquire a business operation. Reduction of office space, 22%. None of these 3%. So again, entering new markets, 32% of respondents, and stabilizing the supply chain, 32%, are seen as the top drivers of future growth. Close behind are leveraging best-in-class technology, including, again, artificial intelligence and maintaining a stable workforce. From the following list, which are the biggest keys to your future growth strategy? Again, we've talked about this. I shouldn't repeat this, but entering new markets leads the way. Along stabilization of supply chain, e-commerce is down below 25%, mergers and acquisitions at 20%. Again, that's 1/5 of you actively thinking about a merger acquisition as part of your future growth strategy. So, if you're an investment banker out there, you're saying, well, this is great, because there are going to be lots of opportunities to work with firms that are being acquired or are acquiring another enterprise. Staying competitive. This is the optimistic perspective. So staying competitive hinges on ERP-driven supply chain prediction, 54% respondents, and customer data analytics, 52%. Despite uncertainty, 75% of companies expect economic conditions to improve. Let me read that again, because this is another thing that surprises me. Despite all this uncertainty, 75% of companies expect economic conditions to improve, pointing to tech-driven productivity and supply chain stability. So here's what's happening. The economy is not going to improve here. That's what the survey is saying, because the Federal Reserve gets interest rates right. It's not even because of the one big beautiful bill and the future tax regime in America. It's because of things that you're going to do. You're going to make the economy better because you're on the front foot, because you're going to embrace new technologies and you're going to implement them and you're going to stabilize the supply chain. 36% strongly agree and 45% somewhat agree that their company has budgeting and forecasting plans to manage rising costs in an inflationary environment. So out of those figures, it's 81%. So yeah, we got a plan. We got a plan, which suggests again that 19% say, yeah, we really don't have a plan, or at least a forecasting plan. We're just taking it day by day. So again, in this process of staying competitive, which of the following do you believe is needed now or in the next 3 to 5 years to keep your company competitive? And again, one of the nice things about the survey is seeing what others are doing. And here's the number one response to this: the ability to gather and analyze data from suppliers' ERP systems to better predict supply chain delays and cost changes. It's supply chain management. And it's ERP systems. Okay, so about enterprise resource planning. We know the world is changing. We need to focus on ourselves, our technologies, our response to the macro environment. That's what's going to make us successful over the next 3 to 5 years. And now, the ability to gather and analyze customer data to better predict their behaviors. There's also overlap between those two responses, as it turns out. Our company currently has the systems in place to keep us competitive. 40% say, we're good, thank you. SAP, Oracle, whomever. Stabilization of interest rates. So interest rates do matter. That's where economies become relevant. The ability to identify when employees are at risk of leaving my company, 39%. Talent. And again, if people are so worried about retaining their talent, that does not tell me that recessionary conditions are present. Right? They are expecting to produce, and they need that talent to produce. Stabilization of inflation, 32%. So again, there are some macroeconomic headwinds here coming out of this response. Now, let's talk about some of those macroeconomic headwinds. So these are major banks' forecasts for U.S. GDP growth in 2025. Again, let me rewind a little bit. In 2023, despite the interest rate increases that transpired in 2022 and into 2023, the U.S. economy grew 2.5%. Last year, the U.S. economy grew 2.8%. Lots to talk about American exceptionalism. The S&P last year returned 23% after returning 24% in 2023. The stock market boomed, American wealth surged, envy of the advanced world. But let me say one more thing about that. You remember coming into the year, how optimistic people were? I mean, the notion among many business operators, not all, we're all different, but among many business operators, the notion was, look, if this economy could do this well under President Joseph Biden, think how it could do under a businessman named Donald John Trump. Right? So the outlook coming into the year was fantastic, but now all this tariff uncertainty in particular, the Federal Reserve's inability to cut interest rates, all of this is weighed on those forecasts. So here are forecasts from Wells Fargo, Bank of America, Morgan Stanley, and Goldman Sachs. They range from 1.1% growth in 2025 to 1.6%. That's quite weak compared to, again, the 2.8% growth of last year. Now, here's 2025's recession probability. So again, major bank or brokerage forecast. Coming into the year, HSBC, and that's the far right-hand bar there, HSBC did not have any percentage attached to recession probability in 2025. That's just not what people were thinking coming to the year. Now that probability is 40%. In 2025, S&P Global, 32.5%, Goldman Sachs, 35%, JP Morgan, 40%. So what's the outlook? Okay, this is my outlook. It's not from the survey, by the way. This is my outlook. So inflation, I think, is poised to stage a comeback. And I blame tariffs for that. Again, I have a bias. I don't love tariffs. But they would tend to push prices higher, right? If people who are importing are having to pay that tariff, and then the actual tariff economically, that burden is borne by many. It's the foreign manufacturer, the foreign distributor, the domestic distributor, and of course, the final consumer. So interest rates will be higher for longer. Back in September of 2024, when there was some thought that Kamala Harris might be the next president of the United States, it was 50-50. The thought was in the bond market was that the Federal Reserve would cut interest rates 6 times in 2025. They've already met 3 times this year, January, March, and May. They have not cut interest rates because they're looking at the data and they're wondering, hey, how are these tariffs going to affect inflation, including over the summer? So the summer inflation numbers will be very important. We'll actually get a very important reading on inflation this week, so watch out for that. Many consumers are now exhausted financially, and circumstances could worsen. So we've seen a proliferation of credit card debt and delinquency. Our loan delinquency is up. Rent payments are increasingly delayed. And so, and the circumstance could worse again because the number one thing that's been waylaying their household finances have been inflation the last 4 years. And now, of course, the tariff impacts are set to impact pricing levels. Not yet necessarily because people are buying out of inventory right now, perhaps. But at some point, 25% tariff against Canada and Mexico, two of our leading trade partners, 30% against the Chinese, that has got to have some effect on price. Our asset prices are overextended. They might be. This may have something to do with tariffs and their impact on corporate profitability going forward, and of course, interest rates going forward, and therefore the multiple on U.S. corporate earnings as reflected in stock prices. So look, forecast was for growth, actually quite strong growth in 2025, but there are now some risks that did not exist as we turn the calendar on 2024, including rising interest rates and falling asset prices, and that's because of, tariffs. So that is my presentation today. We are exactly 11:45, so I've ended right on time as it turns out, and I'll stop sharing and we can go to a conversation.
Well, thank you, Dr. Basu. That was very insightful, and I know we had a bunch of questions come in, even John and I kind of brainstorming as we were going as well. But a bunch of questions came in from the audience. So John, I don't know if you were monitoring those, if you want to kind of jump into a few of those.
Yeah, I think we addressed a few already through the online link. So we will be sharing a recording of the presentation following today. And then also somebody asked about the demographic makeup of those surveyed. That is all contained within our survey report. It's towards the back. So anybody that's looking to get a little more insight as to the demographic that was surveyed, again, it was over 500 people all throughout various different levels of an organization, varying different sizes of those organizations. That's all contained within the survey in our, I guess you'd call it the appendix towards the back there. On to some other questions that we received that we did not answer through the chat box. And if anybody still has any that they want to send through, please do so. But there was one that came through for Dr. Basu. So throughout your presentation, you mentioned the admin playing chess in some regard. So do you think the tariff goal ultimately is to bring manufacturing back as stated, or to rebalance trade? And if it is to bring trade back to the U.S., what do you think the impact will be on China and their manufacturing? In addition, how do you think the U.S. will be able to compete when we obviously see workforce costs being so high?
Yeah, a few questions. A couple of those things are not mutually exclusive, right? So rebalancing trade and bringing trade or production back home are actually completely consistent with one another, right? Because what is the imbalance here? We have major trade deficits in goods with the rest of the world. Not in services, as you know, but in goods, the mantra for the last few decades, and you can correct me if I'm wrong, has been, look, if you want to be a profit maximizer, you must be a cost minimizer. And the way to cost minimize as a manufacturer is to produce abroad, because you're going to get less costly labor, less expensive land, so on and so forth, maybe even some subsidies from certain foreign governments. And so that's been sort of the mantra. But starting with the global financial crisis, and we had some supply chain issues back then, you might remember, starting after the global financial crisis, I should say, around 2010, we started to see more reshoring to America. People looking to simplify their supply chains. There was also a lot of discussion back then about, well, I want to better protect my intellectual property. I don't want to enter into involuntary joint ventures because the Chinese government is making me do that. I want to act autonomously, freely, independently. And I want to have an ability to rely on the local court system if I have contractual or other disputes. And so we saw that in 2010, and that momentum built. And then a crescendo of reshoring with the pandemic. The more supply chain issues, of course, more desire to simplify supply chain, so on and so forth. And then, of course, we had Trump 1.0, now Trump 2.0, and also Biden 1.0, which is, we want to subsidize manufacturing, whether it's semiconductor production or inputs to alternative energy, whatever it happens to be. So supply chain's coming back home, and of course, the Trump 2.0 administration is making a bigger push. So what I would say is this: we're going to see more manufacturing here. Now, You asked the question about labor costs. What can we do? We're an expensive society. We're a very wealthy society. I mean, by the end of last year, total U.S. household wealth was over $160 trillion. Back in 1990, which was not that long ago, it was $20 trillion. I mean, America's become phenomenally wealthy and therefore more expensive as a society. But a lot of this manufacturing that's being reshored, of course, is intensely capital intensive. It's about the equipment. Now, what we could do as a nation, of course, is have the infrastructure, make sure there's enough electricity, make sure that the roads are good, so on and so forth, to support that manufacturing, to connect markets. Our seaports, our airports are modern, sophisticated, compete with their Chinese counterparts. But our labor is more expensive. It's going to be that way. We want it to be more expensive, by the way. It speaks to our living standards here as a country. But again, really capital-intensive production is coming here first and foremost. We've got robotics and AI and all the rest of it. And so we can still compete. So I'm not sure that we need all these tariffs, to negotiate these trade deals. I mean, you could threaten these tariffs perhaps and get the same result, but the administration is choosing the strategy, and we'll see if it works.
Thank you. Next question we have is really centered around the banking environment. So most manufacturers are generally very dependent on funding from banks for either working capital expansion and growth. Do you have any insights on how banks are performing and if they are pulling back or tightening up?
My very strong feeling is one of the things I do is I serve as the chief economist to the Maryland Bankers Association. So I actually speak to a lot of bankers, and in our local market, people from Bank of America, M&T Bank, so on and so forth. I'm from Baltimore, so those are some of the major players here. As far as I can tell, they're on the front foot. They might be reluctant right now to expose themselves to certain segments of commercial real estate, but that's a separate issue, obviously. With Class B and Class C office vacancy rates so high in San Francisco and Los Angeles and Chicagoland and so on and so forth. But I just spoke to a banker yesterday. It was a day before yesterday, Saturday. I was in Jacksonville, Florida. I spoke to a banker, and he said, we just acquired another bank because they had liquidity, right? They had cash on their balance sheet. We wanted them for the cash.
Mm-hmm.
The only reason as a banker you want cash is so you can make more loans.
Yeah.
So I think there's a lot. Now the interest rates are high. What can I do? I mean, we can't do anything about that until the Federal Reserve has, the wherewithal to cut interest rates. But the cash is out there to be borrowed. And then, of course, on top of that, you got the specter of private credit. So there's lots of lenders out there. It's just the interest rate's higher than would have been the case several years ago.
Okay, thank you. Another question that came in through the chat: how should companies evaluate the trade-off between higher costs due to tariffs and the cost of shifting supply chains?
Well, that's a tough one. I mean, I'm an economist. I don't run any factory or anything like that. I'm not a distributor. I'm a consumer. Well, my wife is a consumer, and so, but I would say this. As I understand it, shifting supply chain is expensive. So if the only reason you're doing that is because of tariffs, I'd think twice. Because there'll be another president in 3.5 years. And that president might have very different policies with respect to tariffs. They might be a globalist, right? They might want to, recreate the trade environment as it was in 2018, 2019, pre-pandemic global order. So if you're only doing it because of, you're bearing those costs because of tariffs, I don't know that is sound. Again, speaking as a macroeconomist. But if there are other reasons, supply chain simplification, that your customers are in North America, whatever it happens to be, or you want to better protect your intellectual property, or you're having problems with the quality that's associated with production in some nation in Asia, then that's different. And final point on this, I could actually even be wrong about that tariff part, because you'll note that under both President Donald Trump and President Joe Biden, there is support for domestic manufacturers. So this is not simply a one-party issue. This is a bipartisan issue. Both parties, at least recent leaders of both parties, have wanted to bring more production to America. And so that's more staying power from a public policy perspective.
Thank you. Yeah, and working with other clients throughout the process when tariffs first came on board, we have learned a significant amount of opportunity to save both cost and mitigate risk throughout the supply chain, even without tariffs. So it is an exercise that should be and could be performed. But to your point, Dr. Basu, if it's just for tariffs, it might not make a ton of sense. But what we are finding is that there is other embedded costs in there that some companies can take advantage of reducing, even, sans the tariff issue. So appreciate it. So in terms of the interest rates and the economy as a whole, where do you see the M&A market going over the next couple months? It seems to have slowed a little bit, at least from some people's perspective. So how do you see that taking shape?
Yeah, I mean, I think it's slowed from the perspective of expectations, right? Because again, back in 2024, there was this notion that interest rates were going to come down significantly in 2025. But many economists with whom I speak, and I believe this myself, the Federal Reserve may not cut rates at all this year. And again, that's why the inflation numbers are going to be so important going forward. Actually, we've gotten some positive surprises on inflation recently, but that's before the tariffs would have had any kind of meaningful effect on prices. And if we've seen in certain categories like steel and aluminum, we have seen some inflation recently. And of course, Nucor steel and so on, those prices, those stock prices have been rising since late May. So again, if you're expecting lower interest rates, it's cheaper to finance an acquisition, right? You're leveraging the balance sheet, but it's a lower interest rate. And so relative to expectations, we have not probably as much M&A activity as people would have thought from a 2024 perspective. But I believe, given all the pressures on the economy, all the uncertainty, all the business owners who are in their 60s, that we're going to see a ton of consolidation going forward, that maybe it's 2026 or 2027 when interest rates actually start to come down, that we'll see this incredible flow of mergers and acquisitions. But I think you're going to see a quite aggressive, hot and heavy M&A market at some point in the near future. Again, interest rates have a lot to do with this in 2025 and all the time. But I expect that the interest rate environment will be better for M&A in 2026 and 2027. So that's when you might really see the huge increase, the surge in deal making, because there's this pent up demand for deal flow. Because we've lived with these higher interest rates for so many years. When those interest rates start to fade, watch out. We're going to see so many M&A deals, and of course, more initial public offerings as well.
Okay, thank you. We have one more follow-up. It seems to be the previous question. Are there legal or custom strategies to legally reduce tariff exposure? And are there financial instruments, mechanisms that can mitigate tariff-related cost spikes? So like I alluded to before, we have been working with several clients over the past, let's just say 3 to 4 months, specifically related to the tariff exposure that it creates. And we have closely aligned with several consultants to help walk you through. And there are, we've been working through anywhere from 5 to 19 different strategies that can be employed by various different companies. But it takes time of really understanding the supply chain, where the spend is, to help look and evaluate other different positions they may be able to take. So again, it's tariffs aside, but we have been trying to promote that all folks try to evaluate their supply chain during peak season and even off peak season, at least no less than annually, to see what kind of savings could be embedded within there. So I don't know, Mark, if you had any other comments, because I know you and I have,
Yeah, I mean,
on this.
I think Dr. Basu, obviously you touched on a lot of key points. I think one thing we've heard from our best in class clients is uncertainty creates opportunity, right? And that's whether it's being tariffs or whether it's supply chain, whether it's inflation, whether it's banking, whatever, all the topics you touched upon. And I see the ones that are forging ahead, even when the tariffs is a problem and they're switching from China to another sourcing or whatever they're doing. They're the ones that are making the investments to get out in front of those issues. And the survey touched upon it. Dr. Basu, you touched upon it. I see a lot of clients investing in their ERP, investing in forecasting tools, because if tariffs change again tomorrow, then they go from 10 to 20, whatever the number is, how do you reforecast that back out, and how do you make decisions without real-time information? So I think the hardest part is we do have consultants that we're working with to help mitigate that exposure and kind of create foreign trade zones or some other ways to really mitigate that risk and the cash flow concerns you have with it. But I think without good information internally, you can't make great decisions. So we're seeing it with our client base. We're seeing it in the survey. People are making those investments to get out in front of it. And that's really the best way to stay out in front.
We actually had a webinar back in March, which I believe we have a taped version that if anybody reached out would be interested in, that specifically speaks of the legal and custom strategies. Because we were joined by an attorney, Fred Corso from our office on the international tax side, as well as one of the supply chain consultants we work with. So again, we taped that back in March. So it should be available if anybody wants to reach out.
Well, thank you, John. And thank you, Dr. Basu. Always insightful, always entertaining. We appreciate everyone's time and enjoy the rest of your day. Bye, everyone.